Hello, everybody, and welcome to another episode of Options Discovery on John Lothian News' The Spread. My name is Alex Teng, and just like you, I am no expert in the world of options. But with the help from some, we can learn more about options together. In this week's episode, we're going to be talking about the relative value framework, which is a structure for analyzing the historical and implied volatilities of options. We're also going to get to sit down with the principal of investor education at the OIC, Mat Cashman, where he's going to dig deeper into the relative value framework as well as options volatility analysis. So please stay tuned for that interview and enjoy the episode. So before we can introduce the concept of the relative value framework, we first need to talk about what historical and implied volatility is. Historical volatility is the historical change in the price of the underlying asset or the asset that the option is on. For our purposes, we'll use a stock as an example of an underlying asset. The volatility of a stock is measured as the deviation of that stock's prices from the mean price of the stock, and this deviation can be either positive or negative. Now, there's a few different statistical measures that are used to represent volatility. Some of these include standard deviation and variance of stock prices. The implied volatility of an option is not necessarily a statistic, but it's an estimation of what the market thinks volatility will be in the future. This essentially means that implied volatility is a forecast of volatility used for the purposes of options pricing. In fact, most of the time, implied volatility is calculated using an options pricing model. Now, investors typically like it if implied volatility increases when they're long an option and decreases when they're short an option. And this is because higher implied volatility values typically mean higher options prices. And intuitively, this makes sense because the higher the implied volatility, the more likely an option will end up in the money. Now remember, being long an option means you could have bought either a call or a put option. It doesn't necessarily have anything to do with the bullish or bearish directional nature of the trade that you're making. The relative value framework is essentially a way to analyze the historical and implied volatilities of an option by comparing them or evaluating them against each other. This is usually done by using ratios and can be especially important to take out the bias that can go along with volatility analysis. And this can be even more important when you're looking at the volatilities across different assets, like two different stocks as an example. This example provided by the OIC shows how we can start to develop a new perspective on options volatility by creating ratios between historical and implied volatilities. We can see where implied volatility is relative to where it has been historically. This allows us context on whether implied volatility is under or over its historical value, and then we can make a decision on where we believe it'll go in the future. Implied volatility is important to keep tabs on because higher implied volatility numbers typically result in higher options prices, as I've said before. Stay tuned for my interview with Mat Cashman, where he'll dive even deeper into these volatility ratios and all the great information that you can get out of them. One of the last things that we're going to talk about is how to evaluate these ratios and analyze them over a period of time. One of the most important aspects of any ratio or metric is how it behaves across a certain period of time, and this is no different for relative value ratios. If we plot something like the implied historical volatility ratio over time, we can start to see its behavior. We can see if this metric is currently behaving normally or abnormally by comparing it to what it's been in the past. Questions like, is implied volatility usually 135% of historical volatility, or is this abnormal behavior, can be answered by looking at these ratios across a period of time. All right, everybody, now that we know the basics of the relative value framework, let's talk to our guest, Mat Cashman, who is the principal of investor education at the OIC, as well as a former options trader. Mat knows a lot about the relative value framework and is going to dive really deep into this topic, so it's going to be a conversation you're not going to want to miss. All right, that's going to be it, so please enjoy my interview with Mat Cashman. All right, everybody, welcome to another episode of Options Discovery. Today we have Mat Cashman from the OIC. Why don't you give us your background and just talk about how you got to where you are today?
Yeah, of course. Thanks, Alex. I really appreciate you having me on. Thanks. I appreciate it. My name is Mat Cashman. I am principal of investor education at OIC and OCC. My background is essentially I've been an options trader for about 20 years now. I started in 1999 as a market maker on the floor of the CBOE, and I traded options there for a while on equity options, and then I moved to London and traded options on the long end of the German interest rate curve, so the Bund, bubble, and the shots, which are the German 2s, 5s, and 10s, basically. I spent probably about 3 years over there trading German bonds, and then moved back to the United States, where I started and ran a market making business, an options market making business on the index markets in the United States. That was on the floor of the CBOE. Built that up over the course of about 10 years. It was me and 3 other partners, and we wound that down in 2015. And since then, I have been still trading, but now I work at the OCC and the OIC as the investor education principal, where I basically teach people about options. So I spend almost exclusively all of my time creating options educational content and leveraging all of those experiences that I've had trading options to create the most robust kind of educational content surrounding options and teach people what they can and what they can't do.
Can you briefly explain, what is the OCC and what is the OIC for people that aren't really familiar with it?
Absolutely. Yeah, that's a really good question. It's always important to kind of frame the discussion around like where I'm coming from as far as the organization that I work for. The OCC, the Options Clearing Corporation, is the largest centralized clearing facility of options in the world. Generally speaking, if you're trading an index or an equity option in the United States, the OCC somehow touches it along the way, either through clearing or settlement or the exercise and assignment process, any of those things that happen. And really what it is the end of the line is essentially that the OCC becomes, because they are a centralized clearing facility, the buyer to every seller and the seller to every buyer in the options marketplace. So that all of that clearing, all that centralized clearing facility is really important as far as how the markets function. Now, OIC, the Options Industry Council, was created in 1992, 1993. I apologize. It's an options industry collective that was started in 1992. And the aim of OIC is to better educate market participants and the public as to the risks and the benefits of exchange traded options. So we are out there essentially continuing to pursue that goal through all of the things that we do. The utilization of our website is key, optionseducation.org. You'll see that on some of the slides that we're going to use later on. There's a whole host of educational content that is centered there that is available free of charge and on demand for anyone. And we do that because we are wholly funded by our parent corporation, the OCC.
All right. So I guess as we dig into historical volatility, what is it? So when we talk about historical volatility, what are we talking about?
Yeah, it's really important to understand, right? These slides are meant to teach the idea of 2 different types of volatility. What this says is that volatility, essentially, when you use it as just a general big word, is that it's really just referring to how much something is moving. It doesn't really denote upside, downside, differential as far as up or down. It has nothing to do with direction, and it doesn't have anything to do with necessarily how fast or slow it happens. It's basically just how much something moved from day to day. That's what volatility as a rough concept is, right? This is historical volatility that I just described, right? It's previously. Now, the important part about historical volatility is that it is backward looking. It looks this way because you can't look forward into historical volatility. Historical volatility is based on closing prices. It's a statistic. It's a fact. It is not a prediction. It is backward looking, and it just measures how much something moved. That's all. Implied volatility is the exact opposite of historical volatility. Implied volatility is option related. Historical volatility is really just about how much something's moving, right? A stock or an index, some underlying. It's a measure of how it's moving. Option volatility is implied volatility. It's the main input for all option pricing models. Now, implied vol is the market's best forecast for how much something is going to move, looking forward. That's the difference between historical vol and implied vol. Historical vol looks backwards, and it's a measure of how much something has moved, the underlying. Implied vol is an option input that is forward-looking, and it's the market's best forecast for how much something is going to move. So implied volatility is what we just talked about. It's a huge part of options pricing, and it's really the largest input into how much an option is worth. Vega is a measure of sensitivity for that option, for whatever option you're looking at. Each option has its own Vega, and it's a measure of sensitivity for that option, telling you how much it should theoretically move for every 1% move in implied volatility.
My first question is, what is relative value now? So we've talked about historical volatility, we've talked about implied volatility. So what is this relative value framework, and how does it relate to what we were talking about before?
Relative value is essentially, when you boil it down to its simplest terms, thinking about something in terms of something else. All right, so this slide is really something that I created to try to give you an idea of how you can generally think about relative value. If you look at the first set of cells right there, first set of cells, implied volatility for stock 1 and stock 2, right? You're talking about a 10-day implied volatility, a 30-day implied volatility, 60-day implied volatility, and a 90-day implied volatility. Those will correspond to what I would call a 10-day option, a 30-day option, a 60-day option, and a 90-day option, right? That's really what we're talking about. The implied vols of those durations of options as you go out in time. If you look at stock 1 versus stock 2, the curvature of the volatility profile is suggesting there's a totally distinct curve to stock 1 and something completely different in stock 2. Stock 1 is saying, if you think about implied volatility, as we explained it earlier, as the market's best guess about how much this thing is going to move over n number of days, the market is telling you that stock 1 is forecasted through its implied volatility curvature that the 10-day implied vol, the market makers and the market itself is expecting a lot more volatility in the next 10 days than over the next 30 days, then over the next 60 days, and over the next 90 days. Stock 2 has a completely different volatility profile as far as what the market is forecasting. In this situation, many times what people will do is look at these two stocks. Let's say they're two stocks that exist within the same sector. And then compare those implied volatility levels and the curvature of the implied volatility to what the historical volatility of those stocks is over those same time periods. Now, the hard part about this is exactly what we talked about earlier. Historical volatility is backward-looking, and implied volatility is forward-looking. So what you're really doing here is comparing the historical volatility of the last 10 days to what the market is forecasting for the next 10 days. The historical volatility of the last 30 days to what the market's implying for the next 30 days. And 60 days and 90 days, right? That's really what you're doing. And what this tells you, as far as the way that I set up kind of like the framework of how to look at it, is that you look at it as a ratio. So you take the implied volatility level, the implied volatility number for that number of days, and you divide it by the historical volatility for the last n number of days.
Yeah.
And what that gives you is a ratio of those two vols. And when you express these vol numbers as ratios, the ratios themselves tell their own story, right? Implied over historical volatility ratios then tell you that the 10-day ratio of stock one is a 1.12 or a 112. I would call it a 112. The 30-day ratio is a 116. The 60-day ratio is a 109. And the 90-day ratio is a 141. That tells you that the implied vol divided by the delivered vol of that same time period is expressed as that ratio. That means that stock one's 10-day ratio is 112% implied over delivered. The implied vol is 112% of its delivered vol over the same number of days. When you express things as a ratio, what ends up happening is you start to think about it in terms not of actual numbers, but in terms of relative levels. That's the power of this idea. Because oftentimes people will look at a 65 vol. Look at stock one, the 10-day implied vol is a 65. People look at that and say, that's the highest vol on the board, I should sell it. And maybe you should. I don't know whether or not you should or not. But if you sell a 65 vol and over the next 10 days, the stock delivers 112, it wasn't accurately priced, right? It wasn't a good forecast for what's going to happen. And sometimes using these relative value frameworks and expressing it as a ratio will take some of that bias, that number bias that people have when they see high numbers and say, oh God, I should sell that. Maybe it'll take you a little bit of a step back from that and say, wait a second, I know it says it's a 65 vol, but what does that really mean? What does that really mean relative to how much this thing is moving? How much has it moved for the last 10 days? That's the way that I think about relative value as far as this is concerned. It helps, and that's why the slide is titled as it is, building a picture of forecasted and actual underlying movement using these historical implied volatilities. And all you're doing is taking one number and dividing it by another number. That's all it is. That's the beauty of this whole thing, is that it's a very simplistic way to look at it, as long as you keep in mind historical vol is backward looking and implied vol is forward looking. That's the big difference that you got to keep in your mind when you're trading this way, is that it's not perfect as far as those things are concerned. It's just a way to get a good idea of whether or not those numbers are high or low relative to another number.
Can you explain how that works and how to analyze these over time and how to find those potential levels that you can use as comparison?
Yeah, so when I talk about looking at them over time, what I'm talking about is basically doing the exact same thing that you do when you look at a stock graph. Instead of looking at overall gross price of a stock or something of that nature, you're looking at, and you can graph the ratio itself over time. If you're graphing the 20-day ratio of implied divided by delivered, what it's doing is it's just constantly moving along as time passes and giving you what the ratio of the 20-day implied vol divided by the last 20 days of delivered price is for today, and then tomorrow, and then the next day. Just like a stock changes price, the ratio itself changes price as well. And what you can end up doing after a little while is you can kind of start to see, when you look at things like this, where some of those things tend to live, right? Like where they like to live. A lot of people make a very good living trading stocks just off of their charts. They care about, like, there's support at 80, right? Like that's all they care about. And they're like, when it gets to 80, I'm going to buy it, because there's support. The chart says there's support. The last 5 times it was there, it bounced off of 80. A lot of times those same kind of patterns will start to come out as you look at these ratios. Oftentimes, what you'll find is that when you're looking at the implied divided by the delivered ratio, you'll start to see patterns as to how they move. Sometimes when you can look at those ratios relative to each other in different assets, it becomes even more clear.
one of the things I was really interested when you sent these slides over was the concept of using this framework to build a trade between two different assets, like two different stocks that we had seen before. Can you go into that and explain how to set that up as well?
Absolutely. So this is really this is built on the idea of what I mentioned earlier, which is when people ask me questions about why do I care about implied volatility levels when I'm just trading price? This is why. So if you look at stock one and stock two, right, they both have 30 days to expiration. One of them is priced on, it's a $40 stock. The other one's a $55 stock. The implied vol of stock one is 70%. The implied vol of stock two is a 50%. And they have relatively close prices of their straddles, right? $6.40 versus $6.25. The way that a relative value trader is going to look at this, generally speaking, is they're going to look at the stock on the left, stock one, and they're going to say the implied delivered ratio is a 117. That means that the implied vol is 117% of the delivered vol over the same amount of time. As opposed to stock two, where if you look at that, the 30-day delivered vol is a 55 and the implied vol is a 50. If you do the same math on stock two, implied divided by delivered, you're going to get a completely different number, right? It's 0.91, which means that the implied vol is 91% of the delivered vol. Generally speaking, all other factors being equal, a relative value trader is going to look at this and say, I want to be short the 117 ratio and I want to be long the 91 ratio. Look at what it looks like at the bottom. If an investor sold a straddle in stock one and bought a straddle in stock two, it's important that people understand this involves two separate option trades, but what it creates is something that I referenced earlier, which is what we call embedded optionality or embedded Greeks, embedded gamma. The Greeks for this would look probably pretty neutral. You're short one straddle and you're long another straddle against it. And if you have the ability to model those two things together, it's going to combine those two Greeks and tell you you're kind of flat. You're like pretty close to flat. Your premium for these two trades is relatively neutral as well. You're going to sell the straddle for 640 in stock one, and you're going to buy the straddle for 625 in stock two. Your net premium is going to be 15 cents, right? That's going to tell you you don't have a lot of net premium on. You would be short, you would be considered short the ratio of these two implied volatilities on a 140 ratio. So what this means is that each of those stocks has its own ratio of implied divided by delivered. And that's generally how people look at it and decide whether or not it's expensive or cheap, relatively speaking. What I look at from that perspective is now I'm short this ratio on a 140 because when you take the 70 vol and divide it by the 50 vol, you have a 1.4 ratio. What that generally means is now you can track the ratio of those two vols. And because of the fact that you put this on for a relatively premium neutral amount of money, 15 cents, you can probably track pretty closely how your P&L is going to look as you track how that implied ratio of those two straddles moves.
Is there anything that you want to say to kind of close out this interview before we, wrap things up here?
Yeah, just want to remind people of what we talked about at the beginning for OIC and OCC, right? The best resource out there for options education that is not selling anything. We are non-for-profit. www.optionseducation.org is the website where all of our educational content is hosted, and options@theocc.com is the email address for the investor education desk, where I sit with 3 other colleagues, all of whom have over 20 years of experience in options trading or options brokerage. And if you send us email questions, we can respond to them. We are not registered investment advisors, so we can't direct you on your trades. We answer those questions in a way that we try to give people as much information and education about how the options that they are trading work, and then say, use this basis of knowledge in order to make your best decision as far as how you want to express your view on the marketplace. So options@theocc.com is the email address, and www.optionseducation.org is where you can find all of our educational resources.
All right, and we'll make sure that that is linked in the description of this interview and video as well. I appreciate having you on, Matt, and all the best. Hopefully we can have you on at
Thanks.
some point in the future.
Yeah, I really appreciate you having me today, Alex. Thanks a lot.
All right, everybody, that is going to be it for today's episode. Hopefully you learned something about the relative value framework and got some value from my conversation with Mat Cashman. All right, everybody, check out some more episodes of Options Discovery as well as our other series on johnlothiannews.com, and I'll see you in the next one. Thanks, everybody. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.